Welcome to this presentation on stock strategies, how and when to invest in the share market. With the Australian share market near 6-year highs and the US stock market reaching record highs, many investors will be asking themselves, is it too late to invest in the share market? Like many things in life, the share market does tend to move in cycles. So the key is to know where we are in the share market cycle so we can look at what strategies work best at that part of the cycle. In this presentation, we'll be having a look at some of the cycles related to the share market. We'll also have a look at where we are in that cycle and what strategies work best at this point in the cycle. We'll then have a look at some longer term timing tools, and we'll finish off by having a look at some of the key themes driving the market at the moment. I should introduce myself. My name is Julia Lee. I'm an equities analyst at Direct, and I'll be running you through the presentation today. Now, before I get too carried away, please be aware of this disclaimer as we go through the presentation. Let's start off with where we are in the cycle. Most things move in cycle, and the share market is no different. There's an emotional cycle, there's an earnings cycle, there's the interest rate cycle. Here we'll look at some of the cycles related to the share market, and we're going to start off by having a look at the emotional cycle that can be the share market. Fear and greed are two very powerful emotions that dominate trading. When the market rises and falls, investors' emotions can be like a roller coaster. As the market rises, there's optimism, excitement, thrill, and as it peaks, we still see headlines screaming records, friends talking about their stock portfolios at dinner parties, and stock tips are very easy to come by at barbecues. But once the euphoria has subsided, then comes some anxiety. Many people are in denial, saying stocks are looking cheap and that share prices will come back. And as the market continues to fall, fear creeps in as people who are geared are margined in their investments. I guess the key is to know where we are in terms of this cycle at the moment. It's been a bumpy and a long ride since the global financial crisis for Australian investors. And I would say that we're looking at investors who have some hope in the market and a little bit of relief in terms of the market. But outside of this emotional cycle, what other cycles are there? We'll be having a look at three key cycles of price, interest rates, and earnings. So let's have a look at these cycles. And understanding these cycles really gives us some insight into some of those strategies which work best at different parts of the investment cycle. So let's first have a look at price. Now, price is in the black line, and price comes first. That's because the market discounts future known information. So the black line represents the market. The next blue line is the interest rate cycle. Now, interest rates tend to move in the same direction as the market. And finally, we have the earnings cycle. Earnings are impacted by interest rates and come after price action has already occurred. Therefore, if the market expects to see earnings growth in the current financial year, the market has already usually moved, and prices usually already reflect this view. So the price tends to move before earnings has actually occurred. It moves on the expectation of earnings coming through. Now, different strategies work best at different points in this cycle. As the market is rising, growth and momentum strategies tend to outperform. As the market peaks in terms of defensive, it's the quality end of the market, the blue chips and the large stocks, which tend to do quite well. So where are we in terms of this cycle for the Australian share market? Let's start by having a look at price. This is price on the Australian share market, the ASX 200 index from 2002 to 2014. You can see over the last few years we've seen price rising in terms of the Australian market. So price has been rising. The next cycle is the interest rate cycle. Now, generally interest rates tend to move in the same direction as share prices. However, in this particular case, we've seen interest rates quite flat over the last few years. And in fact, there's talk that interest rates may even move lower. And finally, we have the earnings cycle. Earnings expectations tend to drive prices. So here we're looking at the 12-month forward earnings. And you can see that this graph looks very similar to the price chart that we looked at, but with very similar to the price chart that we looked at. So where are we now? Prices have been moving up, rates have been moving sideways, and earnings will probably move down the current financial year. So we're probably around about these two stages in terms of the share market. This is a stage where the quality end of the market is still outperforming, but perhaps when investors start to think about adding some more growth in their portfolios as the market continues to rise, and if the market continues to rise. Now the next slide is just going to have a look at what's happened over the last 52 weeks. Has it been the quality end of the market which has been outperforming? Let's have a look at some of the best and the worst sectors in the last 1 year. The best sectors certainly are those areas which have a defensive characteristic to earnings, the healthcare sector, or a relatively high yield, the property and the telecom sector. So it has been some of those quality, very conservative type of stocks which have outperformed over the last 52 weeks. The underperformers, well, these have been the growth stocks and the growth sectors. The materials and the energy sectors have been the worst performing on the Australian share market over 2014. So this tells you where we have been, and that has been that the defensive and the quality end of the market has outperformed. The next stage is probably going to be a shift towards a little bit more growth in portfolios. So in terms of the strategy cycle, we were at value where defensives and value are outperforming, and the next part of the cycle is where growth at reasonable prices and higher beta strategies will probably outperform. So that gives you an idea in terms of the Australian share market. But what about timing? Is timing important? Many investors out there would know that the buy-hold strategy has been one strategy that has been very popular with Australian investors for a long time. However, ask a Japanese investor whether a buy and hold strategy is a good strategy, and you'd probably get a very different answer. Just looking at an extreme example, and that's the Japanese stock market. This is the Japanese stock market from 2009 till 2014. You can see it's a very attractive looking graph, and the Japanese stock market has been one of the best performing markets over the last couple of years. However, if we take a longer term view, then the Japanese market does not look as attractive. In fact, since the peak in the market in the early 1990s to the trough, we've actually seen the Japanese stock market losing around about 80%. Now, that's not to say that the Japanese stock market has been a bad investment. In fact, the biggest rally that we've seen during that time was from 2003 to 2007, where the Japanese stock market gained 125%. But I guess the key is if you ask a Japanese investor whether a buy and hold strategy is a good strategy, let's say it depends over what period. And therefore timing can be very important for a longer term investor as well. So what about the Australian share market? Well, let's have a look at the Australian share market. And we're going to have a look at the Australian share market with the 200-day moving average. Now, the 200-day moving average is very much a lagging indicator. And if you were a trader, you probably wouldn't pay too much attention to this 200-day moving average. However, for longer-term investors, it can help them to capture longer term trends. So let's just very quickly have a look at where the Australian share market is in terms of its longer term trend. This is the Australian share market from 2002 to 2014. We have the 200-day moving average in yellow. Now, potential buy signal is generated when two conditions are met. One, that we have a positive crossover, and two, we see a change in slope. For example, look at the first green circle. Here we have a positive crossover where the black line moves above the yellow line, and the second condition is also met where we have a change in slope. The yellow line moves from sloping downwards to sloping upwards. So there we have a potential start of a longer term trend. You can see indeed the Australian share market trends upwards for a very long time until we see a break of that trend in 2007. Initially, that first crossover is ignored, and that's because we don't see a change in the slope of that yellow line. The yellow line was moving upwards and continues to move upwards. But if you have a look at the first red circle, you can see that here we have a crossover where the slope has also changed direction. The slope of that yellow line was moving up and now it's moving down, and that signals the potential end of that trend, and you can see indeed we went into the global financial crisis. Now if we track some of the different changes, you can see we've seen a number of potential starts and ends to longer term trends. I guess the key here is that the Australian share market at the moment is under the 200-day moving average. Now that's usually a negative for investors. However, the slope hasn't changed. So we are just in limbo at the moment in terms of timing and the longer term trend. If the slope of the moving average does turn downwards, that would be a negative for investors, and some of those defensive strategies would probably work better and outperform the market. However, if we bounce off this 200-day moving average and continue to move upwards, then it would be some of those growth strategies which should outperform. Finally, I just want to have a look at some of the themes which are dominating the market at the moment. Outside of the cycle of the share market and timing, there are some unusual circumstances impacting on the share market. And if we have a look at some of the themes and have a look at the performance of different share markets around the world, here we're looking at Australia, China, Japan, and the United States, you'll notice that over the last 1 year, it's been the Japanese and the US stock markets which have been the best performing. In fact, if we have a look at the next slide, we'll be having a look at a 5-year view here, and you can see that on a 5-year view, the performance is even more dramatic. The Australian market has averaged 4%, the Chinese market has averaged -3%, whereas the Japanese market has seen an average of 13%, and the US stock market has seen an average of 14%. Now, I guess one of the key reasons that we have seen these markets outperforming is the fact that we are seeing the impact of non-traditional monetary tools. So we are seeing quantitative easing in the US, in Japan, and also now potentially in the Eurozone. And that means that these markets will outperform. Now in the US, it's a little bit different. We've seen the quantitative easing happen, and now we're probably going to see a normalization of interest rates. So at normal times, some key themes to be aware of is quantitative easing happening in some major markets, and that tends to boost asset prices. So if you see more quantitative easing coming out of Japan, that will be good news for the Japanese stock market. And if you see more quantitative easing coming out of the Eurozone, that will probably boost the Eurozone stock markets. The second theme to be aware of is the normalization of interest rates in the US, and that's going to mean a stronger US dollar as well as a weaker US currency, and you can play that theme on the stock market as well. So if you want to play the currency theme, the falling US dollar, rising US currency, some of the stocks that you could play that theme through include QBE, Computershare, Macquarie. You're really looking for these companies which do have operations and earnings coming from offshore. Interest rates are likely to stay very low here in Australia, and if they fall further, then that would be good news for some of those very interest rate sensitive stocks like the banks, like Telstra, Sydney Airports, Auckland Airports, and Transurban. If you do see low interest rates continuing and rates falling even further, these are the types of stocks which are likely to benefit. Some of the domestic cyclical themes that you might be aware of, the residential housing market is going quite strongly. If you do want to play that residential housing theme and you think that residential housing is going to continue to be strong, well, there's a number of stocks that you can use to play that theme. And finally, retail, with the Aussie dollar looking relatively lower, less competition coming from those offshore websites. These are some of the companies which may benefit. So just very quickly, in summary, we had a look at a number of things, but really we need to be aware of where we are in terms of the cycle, because being aware of where we are in terms of the share market cycle means that we can have a look at some of those strategies which do tend to work better at different parts of the cycle. And in terms of the share market cycle, we can have a look at it in terms of emotions, we can have a look at it in terms of price, we can have a look at it in terms of interest rates, and we can have a look at it in terms of earnings as well. We had a look a little bit on timing and how it can be important for investors. We're really in limbo in terms of some of the longer term trends on the Australian share market. And then we had a look at some of the key themes which are dominating the market at the moment. So that comes to the end of the presentation, stock strategies, how and when to invest in the share market. I hope you have found the information very useful. I do wish you all the best in your investing and your trading futures. Thank you for joining me.